Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to be joined with Ryan Keefe, also a CFP, one of the associates and owners of our company. Thank you for joining us, Ryan.
Thanks for having me.
What we're going to be talking about today is unemployment. Great topic. Idea was Ryan's simply because of the fact that we had two clients just get laid off within the last month or so, and actually both had different circumstances, which actually raise ideas that we can talk about with unemployment. It's what do you do when you find out? What can you do between now and the time that you're actually laid off? Sometimes they announce layoffs in advance. Sometimes see you later, bye, and they walk you to the door.
Yeah.
And, but what do you do? It is, certainly one of the most stressful times in one's life. I got laid off once, and it was the most stressful 3 weeks. Unbelievable. Then when I found the job, I was like, cool, this is beautiful weather. I don't want to go to work, but I was stressed. But be that as it may. So what we want to do is talk about it. Layoffs are sad and unfortunate. And sometimes actually, in the one case that we had, when we learned that she got laid off, we said, congratulations, because she wanted to get laid off. Be that as it may. So, what are the common causes? There could be a recession, okay, downsizing, mergers, restructuring, a company shuts down. These are all different causes of layoffs. Now, the good news right now is we're having a reasonably good economy. Job gains have been pretty steady. Unemployment is low. However, I am hearing on the street a little bit, there's less jobs out there.
Mm-hmm.
In fact, I just got off the phone with someone who just left the military and has a lot of experience, is a West Point grad, and is struggling finding a job.
Oh, well. Yeah, there's, a lot of times you can't really predict when your company is going to go through these changes. But, there usually are precursors that can give you kind of an indication that it might be time to start preparing.
Yeah.
And one of the things that you always, preach here are the 7 Ps.
You're right.
Proper prior planning prevents poor performance.
That's 6. We missed one.
Yeah.
For those who are counting.
So that's what we want to really do here is educate, what steps we take and what steps we, preach to our clients to make as well.
And, there are things that we recommend to folks, even if they're not at risk of being laid off, because a lot of times it happens where it comes out of the blue. And
Right.
we have another example of that who, we recommended to Alan to get a home equity line of credit.
Right.
And he got laid off. And all of a sudden I asked him, I said, do you have your home equity line of credit? He says, no. And
It's too late.
That's right. It's too late now. So what do you do? So you find out that you're getting laid off. All right. There are things that you could and should do immediately. And there are things that you should do to prepare for the risk of being laid off. And, one of them is, we always recommend, and it's just a financial planning thing, is you want to establish an emergency reserve.
Right. Right. And generally you want that emergency reserve. People ask, oh, what's enough? How much should I have in savings? And generally the rule of thumb is you want to have 3 to 6 months of expenses saved up and ready to go. That's liquid. You don't want that 3 to 6 months of cash need to be invested in the stock market where it could face all sorts of uncertainty and volatility.
Right. So in the 3 to 6 month range can come into play as how secure are you with your job? How secure is the environment? Like, for instance, if you're in a union job, the 6 months may not be as necessary. But it's just always good to have that emergency reserve. An alternative to an emergency reserve, not everybody has 3 to 6 months of expenses and cash laying around. Or in our situation, we recommend, let's say your cost of living is $10,000 a month, which is not unheard of. having $60,000 in a savings account may not always be practical, or quite simply, you may not have it.
Right.
And so if you own a home, we recommend getting a home equity line of credit. Now, of course, we're always cautious about recommending that because there are folks who tend to be spend happy. And if they find that they get a home equity line of credit, all of a sudden, woo, we get all this free money and access to money and burn through it. That's not the intent of the home equity line of credit.
Right. And the important thing to note with the home equity line of credit, we recommend this to people. And, for example, this one client we just had come in, we recommended that she, get a new home equity line of credit because her old one closed. And the time to do it is when you have a job, because when you go to the bank, they're going to want to see do you have income coming in? And they don't know that you got laid off, but in a few weeks, you're not going to have income coming in. So you want to get that beforehand.
That was the one we just did, right? Yeah. So, and we were lucky because she was notified in the beginning of May that they were doing layoffs and her last day was going to be early July or July 1st or something.
June 30th. Yeah.
So what it did is it gave her the ability to run to the bank where she has pay stubs and she can demonstrate income. Typically takes somewhere between 30 and 45 days to get a home equity line of credit. It gave her the time to do it because now, once she no longer has the income, she now has the line of credit to serve as a lifeline.
Right. Right. And typically the home equity line of credit, I know we've talked about it in several episodes, if not most of them. It provides a nice source of liquidity at a particularly lower interest rate, especially when you compare it to things like credit cards.
Of course. And, the home equity line of credit obviously is a lien against your property. Some people feel uncomfortable about that, and that's certainly understandable. And you also have to have equity in your property.
Correct.
Because, typically some banks and credit unions will only loan up to 70% of the value of your home. And that includes already if you have a mortgage or home equity loan. But let's not beat that horse to death. But it is one of the things that we recommend people have as an emergency reserve if they don't have the ability to save for an emergency reserve.
Correct.
Some of the other things that you recommend for planning in advance?
I mean, if you don't have the ability to save or have an emergency reserve available and you don't have the equity in your home, like you said, one of the things that, at least provides liquidity are credit cards. They are extremely high interest rates these days, which some are unimaginable, but at least it gives you a lifeline and a place to go, so that you can survive until you find that next job. The other accounts that we tend to look at, do you have any investment accounts? If you do, those accounts you generally can pull from and you can minimize the tax impact of withdrawing from those accounts. And what you may want to do is look at how it's invested. And if you're going to need that money in the next few weeks, next few months, even the next year, you may want to consider some safer investments to preserve, the value of that. Because the last thing you want is, we see lots of young people come in with these investment accounts that are very highly risky, whether they're invested in things like the S&P 500, individual stocks. I've seen even some with cryptocurrencies. Those are all fine investments, but when it comes to a short time horizon, you really can't, risk a chance of a serious loss. Otherwise, you're going to be pulling when the market's down, and nobody wants that. And the other source that, we tend to look at are retirement accounts. Obviously, retirement accounts, for the most part, are designed for retirement, and you really can't pull from them if you're under the ages of 59 and a half. However, in some instances, such as with Roth IRAs, if you've been contributing over the years, you can always take your contributions out tax and penalty free, and that provides an extra source of liquidity. And that's usually one of the last places we like to go, just because the Roth IRA grows tax free for the rest of your life. But when you're in need of money, cash is king, and that's a place where you can go.
Of course. And, the last thing, you don't want to be taking money out of, let's say, an IRA, because then not only you're going to be paying taxes on it, but you're going to be paying a 10% penalty. Another one could possibly be, if you're still working with the company, is you may be able to procure a 401k loan. But again, I'm going to be extraordinarily cautious with that, because you're going to want to review your summary plan description, because the rules are you're supposed to pay that loan back immediately. I've seen within 30 days, I've seen within the same calendar year, but I've also seen written in to the summary plan description, which is the rule book for a 401k, is that you can keep it there and then you just have a loan to the 401k provider. So let's call it Fidelity, for instance. If you had a $20,000 loan with Fidelity already in place and you get let go and you were paying, say, $300 per pay period, what they'll do is they'll say, okay, well, let's recast a loan that it's $600 a month, and then you're sending them $600 a month. As opposed to having to come up with the 20 grand immediately, you may not have it. Well, on the reverse side, if you find that you have time to be able to take a loan out, you may want to consider, if you have no other place to go for cash, you may be able to take a 401k loan, okay, to at least give yourself some access to cash. But just remember, you're going to have to make loan payments on that. But again, you have to make sure that your 401k plan allows for it. Very, very dangerous idea, but it's an idea. Yeah. And it's all about being creative with finance and also making it in such a way that let's not do anything rash. One of the things that is very important about a financial advisor, and this is one of the things that I tell a lot of my clients, we have one giant advantage over every one of our clients. And that's we don't have the same emotional connection. I'm not saying we don't care, but what I'm saying is I know the fear. It was like a deer in the headlights. When you lose your job, you have so many things going through your head, fear-driven, that it's very, very easy to make decisions that aren't sound. Not intentionally unsound. You just don't know. You don't know what options are available to you, and you're quick to cash advances from credit cards. You're going to pay 5% for the cash advance, and now it's at 30% interest accruing daily. Okay, just looking for ways to weather the storm in the event that you get laid off.
Correct.
All right. So there's a lot of things that we've also had with clients who get laid off is, now what do you do? Well, got to understand what your severance is. Okay. Is it paid lump sum? Is it paid weekly? And I've actually seen periods where people are given the opportunity to choose between the two. It could be a tax advantage to actually take it strung out over weeks, and it could be tax advantageous to take it all now.
Right.
And you just want to know, and I'm always a fan of know the answer to the question before you implement whatever it is you're going to do. But I've seen people late in the year get a giant severance and take it as a lump sum, driving that money into a substantially higher income tax bracket. And the only people that win are Mr. I, Mr. R, and Mr. S. In other words, the IRS wins because you ended up paying a higher tax on that unnecessarily. Again, understand and know the rules of it if you're given the choice. You want to understand what your medical benefits are going to be.
Right.
Okay. Sometimes they give you the ability to stay on what's called COBRA. And COBRA is nothing more than it's an acronym, and I don't remember what it means, and I don't care. But basically what happens is that you can continue on their medical plan. It's just that the likelihood is the company's not going to be providing their supplement. So you may have been paying $500 a month for your plan, but now that you're on unemployment or you're terminated, they're saying, we're not covering half. Now it's costing you $1,000.
Right.
Just be cognizant of that.
Right. And if, you're the sole provider or the sole person with medical insurance in your family, that's going to be extremely important to determine whether you have that coverage. Because if not, you're going to need to get it and get it rather quickly.
Or with any luck, you might be able to go over to your spouse's, which,
Right.
the spouse would be able to pick it up mid-year because it's considered to be a life-changing event.
Right.
So the other thing is that you want to take a look at not sometimes, vacation is typically considered to be an accrued benefit. So if you have a whole boatload of vacation hours built up, then that may actually turn out to be an additional benefit. There are some companies that will even pay out sick time or PTO. Now, if your company files for bankruptcy, okay, I learned this, okay, years and years ago. If your company files for bankruptcy, I always had the maximum amount of carryover. I had 6 weeks of vacation, always carrying over. Why? Because stupid me never took enough vacation. If your company goes bankrupt, so is all your vacation.
No.
All right, that got wiped out.
No.
Anyway, be that as it may. Then you want to file for unemployment.
Right. So, a lot of times I've seen a lot of questions when it comes to unemployment. And when we say unemployment, we're dealing with Pennsylvania unemployment here. Every state has their own rules. When it comes to unemployment, a lot of times people ask, will my severance affect my unemployment benefits? And a lot of times the answer to that is yes, depending on the amount that you get.
Depends.
Yeah.
Ryan, I'm going to chop you right here. We're at a point, great breaking point, even though I interrupted you. We're at a good breaking point, so stay tuned. We'll be back in just a few minutes, and we'll pick back up with the unemployment discussion. So be right back.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. Ryan, I interrupted him in the midst of it. We're talking about filing for unemployment. And again, we're in Pennsylvania. So pick up where you left off.
Yeah. So we're just talking about, how severance can affect unemployment. The main question that I've seen and heard a lot is, if I get a severance, should I file for unemployment? The answer is that you can. And I'm a big proponent of you should. Just because once your severance runs out and you need unemployment, if you apply at that time, you're going to be waiting weeks to just go through the process of applying and maybe even getting rejected for it, and then having to go through all those hoops. But when it comes to severance and unemployment, it really just depends on how much severance you get. And basically, there's a calculation that if you get this amount of severance and it's over 40% of the Pennsylvania average annual wage for that year, which in 2025, it's roughly around $27,300. You take that lump sum minus that $27,300, and that's what's called your deductible severance amount. And that's what delays your unemployment for a certain number of weeks based on how much you were making.
To be clear, that $27,000 isn't the average income of a Pennsylvania resident. That's the 40%.
Yeah.
The average is about $68,000. So anyway, just to be clear on that. So more calculations than you need to know, but this much for certain. Regardless, your benefit is going to be based upon how much your income was. The maximum benefit is $605 a week, and there's always a 1 week holding period until such time that you get it. They also ask whether or not to withhold taxes. That is one where it depends. If you're truly relying heavily on that income, then I say no. Okay. Now, because $605 a week, if you're getting the max for 4 weeks, it's $2,420 a month. Some months have 5 weeks, but it's $2,400 a month. That's probably way less than your cost of living. And my take on it is, if you need every nickel you possibly can without driving yourself into debt, then you just do the 0% and then know that you're going to have to make up for it. Okay. You're going to have to make up for it later on. So maybe if this happens to be mid-year, then maybe once you get your new job, then you increase your withholdings from your new job to make up for the fact that you weren't withholding taxes from your unemployment. Unemployment is not taxed in Pennsylvania, but it is taxable as income for the federal income tax brackets.
Correct.
Okay. The other thing you're going to want to do is take a look at your expenses.
Yeah, and this is a time where if income's going to be stressed, you're really going to want to take a hard look at your budget, and cut those non-essential expenses as much as you possibly can. People eating out. I can believe how much people spend on eating out and getting delivery these days, but the costs really add up. And there's several other things that you could look to cut that you just don't need to live, that you can always get back once you get another job.
Subscriptions on your Comcast, your Netflix and all that fun stuff. Now, but you may also find that, hey, I'm going to want my Netflix now that I've got all this time on my hands. But, again, it's a function of trying to really, really tighten the belt at a time that the income is significantly reduced. And trust me, it is an extraordinarily stressful period, and you just want to do all the right things. So what other considerations are there? We recommend that you meet with and speak with a good financial planner who can guide you, because again, as I pointed out, at least you have somebody there who can guide you when you're emotionally distraught, to help you make informed, and I hate to use the word, make stupid decisions, but to avoid making decisions that are stupid.
Yeah, and sometimes, all it takes is hearing from someone who's had the experience of dealing with several people or even themselves who've gone through unemployment in the past. It's going to be okay. And you have different options available to you. And sometimes all that weight lifted off a client's shoulders makes all the difference.
Yeah. So some of the things to take into consideration, we've had situations where, again, someone knows several weeks or even a couple months in advance that they're being laid off, is adjusting their retirement plan contributions. Now, as we pointed out, we've had 2 clients who both got laid off or found out within a very short period of time. In the one case, the client was over contributing to their 401k, which is great. However, she didn't have a lot of money in the bank and she was single, so she didn't have a spouse to rely on. So in her case, we said, whoa. You want to reduce your contributions to your 401k to the minimum amount to get your full company match and start socking some of that money away, because you're going to need it when all of a sudden your paycheck goes away. Okay. And then on the flip side, the one where we cheered and congratulated her when she got laid off because of the fact that she wanted to retire anyway. And so this was her way of getting a severance and basically being asked to leave. It was the greatest thing. She was so happy, and we were happy for her, but it was mid-year and we'd been trying to maximize her contributions to her 401k of $31,000. And in doing so, we said, oh boy, guess what? Your time now, instead of being from now until the end of the year, where you got 7 more months, we only have like 5 more weeks. We effectively jacked up her 401k contributions to be able to get the maximum in before she left. So again, it varies in different, because in their situation, they had the financial wherewithal that they were okay, that they could afford it. And this was an opportunity to max out the 401k, because guess what? She's effectively going to begin taking her Social Security and she's going to collect unemployment. She's going to be double dipping there and they're financially sound. So in her case, it was a good thing. One of the things that also happens is for people who make a very high salary, And what I mean by high salary is they've well exceeded the Social Security wage base, which is today 176,200. Is that what it is? 176.2?
I believe it's on there.
So if I'm making $250,000, or someone's making $200,000, let's just say, and they get laid off in March, and they get a 6-month severance package, and then 1 month later they get another job making $200,000. Well, what's going to happen is you're going to have two employers withholding for Social Security, and employer number 2 and employer number 1 aren't communicating with each other. So if you exceed the wage base with one or the other, what ends up happening is that extra Social Security ends up being a refund in your tax return. And if you know that refund is going to be coming in your tax return, that always gives you the ability, if you do tax planning in advance, that you can actually reduce how much you have being withheld from your paycheck every week.
Right.
So we're going to wrap it up with the next steps. So what do you do when you get laid off? Ryan, I'll let you pick it up.
Well, so once you've kind of, let the dust settle of the emotions of finding out you've been laid off, now it's time to, go up, update your resume, and update your LinkedIn profile. Say, hey, I'm out here, I'm looking for work. Those two things are going to be crucial because, in a lot of cases, you've been working at this job for multiple years. You probably haven't updated your resume since you got the job. And, you would just want to be prepared for when that interview happens, that you can go out and start searching right away. You're also going to want to brush up on your interview skills. Same thing with the resume. You probably haven't, practiced interviews in God knows how many years. So you're going to want to, get refreshed, refocused, and, determine, how can I go get another job, that suits my skill set. And you just want to be prepared for today's interview environment. A lot of times interview questions and tactics change over the years. A big thing that I always preach to our clients, tap into your support system. Don't necessarily, hold it in that you've gotten laid off. Thousands of people have gotten laid off in life. And even some people who are very well put together get laid off for no reason other than, the company just went through hard times. Doesn't mean you're a bad employee, and, it's not a shameful thing. And you'd be surprised, a lot of times I tell younger clients, hey, tell mom and dad. Sometimes mom and dad can be a nice financial support system, or at the very least, an emotional support system for you. And the last thing is just make sure you put yourself out there. Put yourself out there for as many jobs as you think you want to do, because you never know how long certain interview processes will take. And you just want to make sure that you're back on the horse, sooner rather than later, and get this stressful period behind you.
Yeah, you've got a lot of sources out there like LinkedIn, et cetera, et cetera. But there are a lot of consultants out there who can help you brush up your resume, who can help you with interviewing. I mean, there's probably going to be a cost to that, but still, it's a cost well worth it at the end of the day if it makes the difference between you getting a job and not getting a job. So fundamentally, we're wrapping up here. Fundamentally, what is this all about? It's about planning, okay? Planning before you potentially could get laid off. Position yourself with an emergency reserve, potentially a home equity line of credit. You find out you're getting laid off. Now there's more planning to do. Planning on what you're going to do between that period of now and the time that you're actually being laid off. Planning for finding another job. Everything comes down to that key word, planning. Nobody plans to fail. They just fail to plan. Pull that one out. So anyway, I hope you all learned something. It's never a good idea. It's a sad thing when layoffs happen. It's a very emotional thing. It is a shameful thing, all of those words. But at the end of the day, pull yourself together, do your planning. So thank you for joining us. I hope you have a wonderful day. Thank you. Thank you for watching this episode of Financial Planning Explained. We strive to provide an educational experience for all of our viewers, and what we struggle with at times is topics. So if there's an idea or a topic that you would like for us to discuss on a future episode, please email us at admin@maaplanning.com, or you may enter it on the Contact Us page on our website at www.maaplanning.com. Thank you in advance for participating and helping make our show successful.